Since I'm on XHB, I guess I'll stay here for a second. So yields are up, as I've been saying in this room, like a broken record. The yields, Treasury yields, are pretty closely pinned to inflation, the inflation narrative. When investors feel like our economy is in trouble, either lack of demand and or the job market is too hot, causing potential increase in prices, the bondholders demand, yes, twin, that's part of CTV. The bondholders demand higher premium, and that typically can be one of the main reasons why yields push up when you get news like you got today. Now, if you remember what we got on Friday, so this is today, this is what, Tuesday? So you got this move here. I believe this maybe was the jobs report that we got last week. The jobs report showed a lot more, what was it, 55,000 more jobs than anticipated. Yay, that sounds great, doesn't it? And there's an auction, yeah, there is an auction today. This typically sounds like, good news, right? Yay, we got more jobs were added. That's good for the economy. Well, that might be true, but not when you are still over 2% inflation. So when you are still in an inflationary phase of the market, you don't want a hot jobs report. Unfortunately, the only thing that brings down interest rates other than rate cuts, the only thing that normalizes the economy, the only thing that really brings inflation down is a rise in unemployment. That sounds counterproductive, but as you've heard me say here before, when inflation, the big I, when inflation is high, that's bad. And the only thing that breaks it, is when the demand, U.S. demand, consumer demand, falls. If we slow down our spending, if we slow down our buying and our consumption, that naturally brings prices down. That's the way it's supposed to work. So how does the Fed accomplish this? One of the tools they have is to raise interest rates. By doing a rate hike, it puts pressure on companies. Companies don't like it. Why? Because their borrowing rates are significantly higher. And most large companies borrow billions, collectively billions, dare I say trillions of dollars throughout the year for research and development, for construction, for new factories, new buildings, new whatever it is, more products, inventory. Companies load up on debt when things are good. That's how they're able to leverage, whether it's advertising costs, new hires. The cost of money is very important. So when rates go up, that hurts companies. Now, the algorithms that have been programmed in this market by hedge fund managers, institution managers, and such, they know this. So there are algorithms designed that when yields click up, it automatically triggers sell orders in equities. Why? Because they know the relationship between higher interest rates and companies that struggle to borrow money or their costs go up. That hurts their bottom line. If it hurts their bottom line, it's going to hurt their stock. And as a result, investors are betting that the equities will go down when yields go up. Does everybody understand that relationship as I just described it? Those of you that are brand new, does that make sense? Higher yields, more expensive to borrow. Companies don't like it. Algos are programmed to sell off when yields go higher. So what breaks the cycle? Typically what happens is when companies start to sell off because interest rates are higher, they need to make an adjustment. They need to get healthy immediately. And they're only, and I do believe this, they're because I saw it happen with my own companies in the past. The only answer that these companies have is to lay off workers because they can't negotiate lower prices for wholesale product that they buy. They can't negotiate for lower energy prices. They can't negotiate for lower freight costs. They can't negotiate for lower labor costs. They can't negotiate for anything. If their costs go up because of inflation, energy costs are higher, product cost is higher, borrowing costs are higher, their bottom line is affected. And so the only way that they can get the bottom line to be healthy again is to lower their payroll. It's the only thing they have control of. Can they go to their landlords and tell them to lower the rent? Can they go to the banks and say, hey, can we skip a few payments like for the next 6-7 months? Can you do that? No. FedEx, hey, can you give us like a 20% discount across the board for the next 6 months? No. So what other area do companies have, large companies, to make up for the fact that they're paying more money to borrow and to keep their companies alive and growing and thriving? What other area? If someone knows the answer, please shout it out. But trust me, there isn't any. I've had several businesses, many businesses, and when I got pinched, there was only one place to go, unfortunately. I couldn't, when I was in the cell phone business, I couldn't get, and the carriers started to squeeze my commissions. What could I do? Fight them? Okay, I went to another carrier. Negotiate with my phone manufacturers to give me better prices so that my margins were better? No. Negotiate with my salespeople to pay less commissions so I could have more money? No. Negotiate with my landlord so rent was lower? No. Where can I go? How can I go from 15% overall profit bottom line at the end of the month when it dropped down to 4%? How can I get myself back up over 10%? Otherwise, why the hell am I doing it? Why am I risking so much to make nearly nothing? The first place is payroll. And so just watch this. So when layoffs happen, massive layoffs, which we are seeing across the country, and we've been seeing it, when that happens, the companies are able to survive and get in the black again. But what is the result of massive layoffs? Unemployment. The unemployment rate skyrockets. And now U.S. demand drops, right? The consumer demand drops. Why? Because they don't have the money they had before. Many of them don't have jobs, which means their spending is going to slow down. Their spending is going to shift to just the importance, the staples. So when U.S. demand drops as a result of this high unemployment rate, that typically brings down prices. When demand is low, that's when prices come down. This is the natural order of things. And then they can start to hire again. The country gets healthy again, and yields come down. And then it becomes more affordable to borrow. And then what do? We borrow more money. And so do they. Until. And this is the cycle. Unfortunately, because of the last 5-6 years, inflation rose so high. And some policies were so detrimental to the economy that we have yet to truly recover from, at one point, we were at a 9% inflation. Energy costs were through the roof. And because of the migration in the southern border, we had tens of millions of consumers, utilizing resources, whether that be hospitals, schools, taking low-wage jobs from American citizens. There was like a rolling of effects that we have yet to really recover from. And as a result, even though energy costs came way down, the massive migration slowed down, we started to get inflation under control. Then we were hit with the Iran conflict. So oil prices spiked, energy prices went back up, and inflation kicked up a notch again. So where we are now and where we have been, as I've said, for about 6 months. We're not just in an inflation narrative. We are now in a stagflation narrative. So stagflation is a lot worse than inflation. Stagflation is when the U.S. demand is lower. That is true, although because of the jobs report we got last week, looks like more jobs were added. That is not good for this whole scenario in terms of bringing inflation down. Good for, good for those that have a job. Not good for the overall economy that's trying to bring down inflation. But stagflation is a condition when the demand is lower than normal, but the prices are sticky. They're not coming down. See these dots coming down? They are not coming down. Prices are remaining higher. When you add the oil scenario that's happened over the last month or so, that pushes prices even higher. So now we have rising inflation / stagflation, demand low, and that is the worst scenario. That's something that can lead to recession very quickly if the Fed makes a wrong move. So what do you do? Well, the Fed is kind of out of bullets. So at this point, I'll just give you one other scenario. One of the ways that the Fed can stimulate the economy, which you don't want to do when you are in a stagflation or inflation theme, is to cut rates. Now, if you know, you've been watching along for the past year or so, companies have been building in a rate cut for quite a while. They want a rate cut. Why? Cheaper to borrow money, they can expand, woohoo, flush with cash, let's grow this thing, right? They want lower rates and they want a rate cut. Rate cut usually stimulates the economy, but you don't want to stimulate the economy similar to stimulus, like injecting cash payments from the government to stimulate the economy. That is one of the worst things that you could do. I know there are moments in time where it helps a lot of people, but overall, it is bad policy. It's bad policy when Bush did it. It was bad policy when Trump did it. It was bad policy when Biden did it. Don't do it. It causes inflation. And when you already have stagflation, it's the last thing you want to do is to add stimulus. Give people that don't have jobs a bucket of cash that they can go out and spend, increase the demand, and jack the prices up even higher. That hurts even more people who can't afford baby formula as it is. So these rate cuts that were on the horizon, if you look at the stagflation picture and the jobs report that came out last week, the CPI that came out this morning, the PPI that's going to come out tomorrow, all because of, oil prices driving this higher, the cut scenario is off the table. So we are not going to get a rate cut anytime soon. And companies have built in the rate cut scenario into their metrics. That's bad for companies. So you are going to see a potential sell-off when it really becomes evident that we're not getting a rate cut. In fact, what we might need in order to kill stagflation, dare I say it, is a rate hike. Oh my goodness. You're going to see a super crash, but you might need to get a super crash. What do you do when the country's biggest companies are so overvalued by 10x, 20x, 50x, 100x? What do you do when those companies are so overbloated and so overvalued? They were counting on a rate cut. They've been pumped and dumped and manipulated to the point where they are so unaffordable for the average investor, overvalued, and our economy is sort of on the teetering edge of going into recession. What do? You're going to have to crack the egg at some point. So this could be coming. It makes people very, very nervous. What has been happening, though, in this particular market recently is that investors and traders have completely ignored all of these metrics that I'm talking about. It's not that they don't know about it. It's not that they don't know about it. They know about it. They know that the rise in oil because of the war in Iran, or whatever you call it, conflict in Iran, they know that they're saying, well, we think it'll be resolved at some point. So let's not worry about it. Inflation, that'll be most likely resolved. Prices will come down. So they're not worried about it. Stagflation, it's the S word. We're not going to, we won't worry about that too much. The dollar's fine. The dollar's kind of low. It's coming down. That's okay. That'll help our imports, our exports. That's okay. Forget about that. Don't worry. They'll still do a rate cut. At some point, they'll cut rates and everything will be fine. Don't worry about that. And so what do? They pump. So you've been seeing one of the most incredible pump schemes over the last 3 weeks that I have ever seen since I've been trading. No rhyme or reason. It's like what they did with NVIDIA two years ago. They just jumped. They dumped software, talking about how software was obsolete. And they jumped on the AI bandwagon. And software took a dump. And then they switched over to hardware and said, okay, let's just pump hardware. And then hardware started to take a dump. And then they said, let's switch back over to software. And actually, let's do software and hardware. Even though AI is slowing down, the data centers are closing or being put on pause, we're not quite sure. Fuck it. Let's just buy the chips. We know they're falling apart, but it's the safest place to put our money because it's where everybody around the world will just jump on that bandwagon. So what did they do? Qualcomm came out with a shitty earnings report. They pumped it. AMD, decent report, good report, not stellar. They pumped it. NVIDIA, falling apart, but they kind of jumped a little bit on the bandwagon. Micron, pump it. Like they had just been pumping these stocks by buying out of the money calls in such massive quantities that the market maker has to drive up. That's called a gamma squeeze. Gamma squeeze combined with a short squeeze as investors were short and needed to buy to cover, buy the dippers that were coming in at the last second, retailers coming at the last second. You've seen this huge surge. What will stop the surge? This right here. Gap up in yields. Bad inflation numbers will take over the narrative. So if you look at stocks like MU that have been on a tear, look at yesterday's price action, look at that wick, and look at today. Down over 8% today. Doesn't sound like a lot considering these. I mean, look at this huge. Look at this. This is incredible. This is absolutely insanity. This is all squeeze, not real. Overvaluation. And finally, the result of all we needed was a catalyst, just a catalyst to come down. Yeah, and this literally looks like the .com bubble chart. Oh my God, and then down she goes. And this will be a lot, if it happens, it'll be a lot bigger than .com bubble burst, for sure. Thanks for watching. Hope you enjoyed this video from Trade With Me Now. Make sure to go ahead and like this video and subscribe to our channel so you make sure that you catch our next video right when it's released. Also, if you have a question or comment, please leave that in the comments section below. And of course, if you want to learn more about Trade With Me Now or join our community of profitable traders, go to tradewithmenow.com. There's also a link in the description below.